Hey, welcome to another edition of Nucleus Investment Insights. Today we're talking Liberation Day fallout. I know I said we were going to talk about some energy, but I think it's obviously much more important we address what's going on, what the issues are, where we think the damage will be the biggest, and just talk about sort of portfolio positioning and what investors really should be doing. I have Dave here ready to come in, but just before I get to him, I just want to highlight that anything you hear today is general in nature, that any advice you hear, it's not personal financial advice. If you do want to get personal financial advice, you can follow the links and book yourself in to have a chat about how this might be playing out in your portfolio. So without any further ado, Dave, welcome aboard.
Yes, happy Liberation Day to you.
Yes. Feeling more and more liberated. So we've got a fair bit we wanted to run through. And Dave, I guess as well, it's probably fair to say that I think there's a lot of stuff we've, Dave and I discuss and bounce around on the portfolio. This one obviously has only been like a couple of hours of info. So there's still a few things we're hashing out. But I thought it's probably just as good a forum as any to discuss that and what we're doing. So we might start with the just a quick agenda. So we're going to talk about what was actually out there. The question about is this going to be one round or multi-round and the implications, sort of this crossfire idea that there's actually a lot of this is a very blunt policy that's looking at, and there's a whole bunch of things that could happen in terms of countries and sectors that could easily be hit in the crossfire. And Australia sort of ranks relatively high in that. We'll talk about exclusions or what we know about exclusions so far. Keep in mind that we're still relatively scant in terms of detail. We'll go through China, talk a little bit about China. I want to talk about the Mar-a-lago Accord and the Bessent plan and how this sort of fits into what they are, and then finally that sort of economics and markets. So higher prices, supply shock. Dave, let's just start with you on this one. So certainly they all came in a fair bit higher than expected.
Yeah. I mean, if you take Goldman as a sort of benchmark of Wall Street, they're expecting an effective overall tariff of about 15%. Instead, it's come in at 20%, which, we haven't seen since the Second World War. So it's a big unwind. Excuse me. So, I mean, without mulling any reciprocal or response tariffs, this is going to be a pretty decent inflation shock for the US. Excuse me. It's the kind of inflation shock that the Fed would typically look through, but given, they're still wrestling with the last remnants of the last inflation pulse, they won't look through it as much as they would normally. And so it's going to have, a dampening effect on their easing. That's on top of, what kind of implications this has for manufacturing supply chains. At the moment, services seem to be largely excluded. We'll come to that later. And on this front, we've been looking at various sectors and segments. It does look, at this point, a fairly blunt tool. No doubt they'll refine it over time, but being blunt means, some very large sectors in the US economy that manufacturers and stuff are going to be paying a lot more for their components, and so those that come from outside the country. I mean, obviously, those that have local supply chains will be instantly far more competitive. And so, this is going to represent a pretty given the size and swiftness of the tariffs, it's going to pose a very immediate and dramatic challenge for a lot of local industries that rely on international supply chains, and so there's a possibility of scrambles for parts, etc. How does any business at this point? There's some more clarity here, but I'm sure absolute clarity on the particulars for every sector will take even longer. Not because negotiations between countries, and we don't know what kind of retaliatory stuff we're going to get, and so we're in an extremely chaotic environment now, where business decisions on where to supply, assemble, and even promote your products are in complete flux. And so, we're talking some very big industries here, cars and phones and, all sorts of things. So I think basically we're looking at a pretty serious growth shock that comes with this, as CapEx plans, kind of pause, if not stall, because, it's going to take time to figure this out, and then a lot more time to even deploy a new plan to restructure needed. And in the meantime, you might just have to keep importing parts that are now unprofitable. And so there are margin implications for some sectors and earnings. And so, it's really difficult. I think, I don't think that this is, very well planned. I think it's very swift, and the messaging is very chaotic, and that's adding to the downside risks. It's not that you necessarily couldn't do this well to actually deliver the outcomes that the Trump administration is after, but they're not doing it well, I don't think. And so the implementation risks I've been talking about for a while look real, and we know as well that they're on this fiscal austerity drive, and you put those two together, and you're going to get a pretty good growth scare here coming out of the US. So higher prices, growth scare. Bonds were bid last night, even though we would expect high prices, and that's indicative that the growth scare is already foremost in the mind of markets. And that's before we get to escalating tariffs. So if we get escalating tariffs, then this could get right out of hand for markets, I think.
Yeah, and it's worth
and on that front, I'll just finish that bit. Like, there are signs that in some some weird alliances are forming against it. So Canada has been edging towards the European Union, a possible alliance, and even China, Korea, and Japan are like talking about collaborating on retaliatory tariffs, because individually they'll go none. So, and that's like unprecedented kind of cooperation in North Asia. So yeah, I mean, it's to say the least, it is a state of flux. Yeah.
I mean, there's escalating tariffs and there's de-escalating tariffs as well, in the sense that, I guess your optimists at the moment are basically saying, well, the stick's been put in the sand now. Everyone knows what roughly what the criteria are in terms of why the tariffs are higher on some countries rather than others. And so therefore, if say, Vietnam decides it wants to get its tariffs down, it knows what it needs to do. So that's sort of like your bullish case from wherever it settles in the next couple of days. And then the bearish case obviously is that, what you're saying there is you get groups of countries then start saying, well, we don't want to get picked off one by one. So let's now go together and say, okay, this is what our response is overall. And
Yeah.
Yeah, and then the other one is just I've put in Beggar the neighbour, but it's a little bit obscure, but it's this idea that look, there's lots of policies you can do which are based around the idea of saying, I'm going to try and grab as much for my country as I can at the expense of other countries. So rather than saying yes, let's accept that our country is going to import some items and export other items, and we win on some and we'll lose on the others, but net we're all about right. Is that countries start going, no, we need to be a winner in every single case, and I think Trump will I guess his tariffs against a country like Australia, for example, might be more into that, where it's like, well, we've already got it. Australia's got the opposite problem to most of these other countries, where we're importing more than we're exporting, but they're still targeting us with the view that, well, there's we want to win every trade deal, and if every country starts trying to do that, that's where you get those. It might not even be tariffs, but there's just all exclusions and other sort of soft sort of tariff measures that get put in terms of other under the guise of other quality or a whole bunch of other methods, just to that end up in that same part. So it doesn't necessarily have to be escalating tariffs. There's lots of other things that can go wrong on that front.
No, it doesn't. But, the reciprocal tariffs take in non-tariff barriers as well, right? So, things like VATs and various other protections.
Yes.
It's Australia. Look, we'll come to Australia. That's fine. But
okay, so let's move on to the next
step. So let's just crack on.
Yep. So next step is this crossfire idea, and what else can get caught up in the crossfire, and the first thing that sort of comes to my mind is, look, the US is effectively saying we want more manufacturing. We've let all our manufacturing go to China or other countries around the world, Mexico, Canada, Vietnam. We want it back. And so we're putting up these tariff barriers so we can get. US wants to increase its global share of manufacturing. At the same time, you've got China, who's already built all this capacity, and a lot of others. I guess you can probably pick a lot of those other countries as well: Canada, Mexico, Vietnam, all these ones who already have capacity built. And so tariff barriers are going to come up. They're going to sell less to the US. They're going to have spare capacity. China most of all, but some of those other countries as well. A lot of these countries, say the EU or Japan, have sort of trade barriers up already, and your questions around those. So the question for sort of in this front is, who's going to get caught in the crossfire of their manufacturing sectors are just going to get smashed even more because the big countries are all putting up these barriers, and Australia sort of comes up as one of those countries where
everybody else.
Sorry, what's that?
Everybody else.
It's
crushed.
That's right. So if you're a manufacturer in one of these other countries,
their industry is.
Yeah. Are you going to be You're basically going to be seeing dumping coming from all the countries that have got the excess capacity and less ability to supply to the US. So issues around that. Yeah. And then the other part David spoke a little bit about at the start is the idea that services look. You can see why the US excluded services from this, because the US dominates services, and so they're one of the biggest exporters of services globally, and so they've sort of very much kept it all to manufacturing, but that doesn't mean that the retaliatory stuff will necessarily be in manufacturing. So, for a lot of other countries, the only tool they do have to pull is probably, or lever they do have to pull is in the services side. And so there's potentially a shoe to drop on that side if we start to see services sort of start to take off in that front. Anything else on Crossfire, Dave?
I should say just quickly. A lot of what the US is saying is true.
Yes,
I'll just make that point. There is a lot of cheating, and there is a lot of, in particular, behind the border protections in these countries that are unfair to the US. So you could one possible outcome is that, and this is the approach I expect Australia to take, is a kind of enlightened self-interest where the retaliatory stuff will be measured. So we don't get into, the big spiral, because if, an enlightened self-interest will recognise that the US has a point here.
Yes. Yeah, absolutely.
And come to the table. So
yeah, that's right.
that is the most hopeful kind of scenario. I mean, there are the sticky wicket there. I'm probably most talking about the EU there, but the sticky wicket is China, because can't do it, like, because they have the centralized political system, the Chinese Communist Party, etc. They simply can't decentralize their economy to consumption. Like, you can't do that. Well, they don't want to do it because it comes with, expectations of freedom, etc. And so,
but this is part of the issue, isn't it?
Contemplate that. So
this is the large part of the issue.
Is
China was granted access to the World Trade Organization with the whole idea that they would then become more, they'd open up their borders, they'd allow more trade, they'd become more democratic, that all these things would come about because we're now incorporating China into the global trading system. And the reality is they haven't, they did for a while, and then backtracked them on them all.
No.
And so that's really where a lot of this comes from.
That's right. And moreover, the so-called liberalisation is all behind the border force-in policies, right? Which is about attracting supply chains. So they very deliberately, they've engineered an economy that would steal other people's industry.
Yes,
very simply,
and arguably to a lesser extent.
Down.
Sorry, you're breaking up a little bit there. Yeah, so China's a lot about that, but currency manipulation part, whereas say Germany is sort of, arguably a similar type of direction, where they did a wage accord back sort of post-pandemic. Sorry, not post-pandemic, post the financial crisis, that sort of kept manufacturing wages a lot lower than what you saw in the rest of Europe, and did effectively the same thing. And because they're in that sort of group currency, they're taking advantage of the fact that. So it's all about saying, countries would love to have higher.
It's over for Europe, isn't it? Like it is over for Europe, because their pump was cheap, turning cheap Russian gas into global value-added products. So their model's busted. And that's why I think there's greater hope that we'll see, and you're already seeing this in the breaking of the fiscal rules in Germany and other things. That'll trickle down through the whole EU. So there's a much better prospect of getting some kind of deal, I think, with the EU and potentially Japan than there is with China. So that sets you up for some relative winners and losers in terms of potential fallout and crossfire for economies and markets.
Yeah, and I think that's this is this part about the so I guess we're giving some credence to that. The US do have some genuine concerns. The other thing about the whole and I know we spoke about it being very blunt, which in some ways is bad, but in other ways, sometimes simple is simple better than complex, in terms of just saying, if there's a global whatever it is, and it's not subject to people managing to negotiate a better rate because they happen to book out a whole bunch of suites at Trump hotels or whatever it is. Like, sometimes you can get I don't know. I'm thinking about some fiscal rescue plans in the US for the entire economy, and they're being held up while somebody gets something written in there to save arrow manufacturers in some obscure state or something. And it's that part about saying, sometimes simple basic rules can be better than complex, multiple versions of it. But the potential is, in this case, as he said, it hasn't sort of been well thought out, and there is a potential that we get the worst of both worlds. Is that there's simplicity, but then you start getting overlaid with this person kowtowed enough to Trump to manage to get something. Yeah.
I think, well, we're certainly going to get plenty of that, I think, but I'm a big fan of big dumb rules for regulation. Not entering supply chains, because I mean the unintended consequences are going to be huge.
Yeah. Now the other thing in that whole thing is the cost. What's the real cost of a local job? Because the other thing is, effectively, I mean, as many people have pointed out, look, these are genuinely going to cost US consumers. So if you're buying steel, whatever, you're buying screws at the local hardware store and you're paying more for it, that is genuinely costing you more, but it is saving some US steelworkers' jobs somewhere. And it's this idea, but around, I think that that falls back to this whole part where there's a sort of purist point of view, which is, you always do as much trade as possible, and then everyone gets the lowest cost, and it's great for everyone. But then, if you do get countries cheating the system, then you can end up with, that issue about, it might be fine if you've got lots and lots of cheap goods, but if nobody will employ your workers because every other country is stealing all the manufacturing, then that creates that problem. And I think Australia is going to be facing that problem in the coming months and years. I think as we doesn't seem as if we will put up any barriers. And so I guess it's a question for what part should these things play? Yes. Can we talk exclusions? So now we don't know for sure. Like these ones there's been talk about these exclusions. They were mentioned in one of the notes, but there's really just not enough detail around this to know what's going on. But copper, semiconductors, pharmaceuticals, lumber, and this other, which was there's basically other stuff that the US doesn't have that they want. Effectively, I think is sort of like it's. So there might be something like something like lithium or something like that, where they're like, actually, we don't think we can get enough lithium, so therefore, and we really need it for batteries, and so therefore we'll let that one through as well, or whatever it is, rare earths or something like that. The big ones I want to note just from a company perspective, the lumber's a bit here nor there, copper as well is a bit neither here nor there, but semiconductors and pharmaceuticals. So the semiconductors is big. And getting more detail on that is important. So if they're excluded, then all the parts and all these AI things that are all being built in the US is obviously a lot stronger. The outlook's a lot stronger for that if they don't have a 32 or 34% tariff. Can't remember what the Taiwanese one was, but lots of this stuff gets made in Taiwan. Fair bit gets made in the US as well, but lots gets most of it gets made in Taiwan. And so if you're sort of going to turn around and all your NVIDIA chips are now 34% more expensive, that's a big deal. I think they're excluded, but it's we don't really have enough detail on that as yet. So that's sort of certainly be somebody to be watching that space, and sort of similar a bit with some of the pharmaceutical companies in terms of what the issues are for there. And that's probably a bigger deal for, I guess, India rather than a lot of other countries, just given the amount of pharmaceutical stuff that gets done in India. Anything else on exclusions, Dave, that you've seen?
The media is reporting here that Australian pharmaceuticals and critical minerals are exempted.
Yep.
But there's no word on beef yet. And beef was obviously singled out by Trump in his speech. That said, I'm not really worried about beef because two reasons. I mean, BSE is the main reason that Australia doesn't import US beef. Not that there's a lot of it there, but there is, some mad cow in the US. and so it's a more of a qualitative barrier than it is quantitative, and the major competitors that Australia has into the US, Brazil and Argentina are the main two. They have the same new tariff as well. So
it's also
I wouldn't
commodities.
expect a big blow.
Yeah,
anyway.
it's also the whole idea that it's just commodities anyway. So the US will use a bit more of its own beef, and Australian beef will end up somewhere else, or whatever it is. It gets shuffled around the globe.
Yeah,
Australia will sell it somewhere. I guess
that's right. But I'd still expect a lot of it to go to the US. I mean, just on the qualitative side, So
yeah.
I mean, I don't think it's a huge deal basically for Aussie beef.
No, actually, and on the exclusions, just a question one, or I guess a comment one from Groucho Globe, just about tariffing gold to the US. I'm pretty sure bullion. Well, sorry, I'm not sure gold in particular, but I think I remember seeing the word bullion in particular was excluded. Now, what that actually means, it is hard to tell, but potentially there's something on that gold front as well. Right, so is that one big? So moving to the big one, China impact. Yes, I guess probably the biggest first question is, do you think China's going to escalate or de-escalate? What's their?
Well, I think if they're sensible, they'll de-escalate. Are they sensible? I have no idea. I really don't know what they'll do. They've certainly de-escalated so far, but the issue for China is more long term. I think whether they escalate or de-escalate, and that is that they actually can't give America what it wants, which is a consumption-led economy in China. They just can't do it. So it's ideological, it's political, it's pragmatic, it's demographic, it's everything about the place. So I mean, that bodes poorly for a Mar-a-lago deal. It bodes poorly for a quick resolution to this, although they can always promise bits and pieces, and lots of people are talking up Chinese consumption, and it has had an okay kind of 3 months, but it's all on the back of just kind of vouchers and giveaways and trade-in programs, and it's not about shifting national income from the CCP to households. It's just not about that, and that's what you need to do if you want to build a consumption-led economy. So, it's a structural schism that they can't get over. So they may try and de-escalate and do what they did in round one, I guess, with various promises, just play for time, etc. I guess what they'll do, and try and get some kind of deal done. But in the meantime, I mean, the other North Asian countries, if I were them, I'd be trying to get a deal done quick, like Abe did, rather than Shinzo Abe in round one, rather than that will be good. Like that, if they all kind of get together and put on reciprocal stuff, then I just think we're in for a global recession, basically, if we go that way, which is in nobody's interests. So I would expect some kind of muddy the waters, de-escalation kind of thing from China, but who knows really? I mean, what they'll do. I don't think you can get genuine change. I do think that they'll take a growth hit this year, like 1% to 2%. They are throwing a lot of sovereign bonds at their growth problem coming out of property, but there's no end in sight to that growth problem. Like, they're really just trying to backfill it with government spending. They're having a little bit of success, bit of consumption, bit of infrastructure, bit of this, bit of that. But basically, it's just weak Chinese growth and deflation ongoing, and this will make that worse. So that starts to sort of shift towards the outcome for Australia, even though the direct impacts from the tariffs are going to be minor. The generalised impacts are going to be quite, I think. And so a spread in retaliatory tariffs on steel already, lots of it, and I think that'll continue. So, I would expect Chinese steel output to fall. In fact, they're talking about cutting at 50 million tonnes anyway. I expect that to continue. All the base metal markets are in free fall. Copper has got another bubble which is about to burst. Excuse me. And they're all sort of starting to hint pretty strongly at hard landing for the global economy. In Australia, a flood of cheap goods, as we've already discussed, as dumping from just about everywhere. It comes to bear on any economy that doesn't protect itself, and that will be Australia. So lots of goods deflation coming in. So that's good for finishing off what's left of inflation here, which isn't much, quite frankly. So we'll probably overshoot our inflation targets, and then, as I say, the direct are pretty minor, so not such a big deal. So China's the sticky wicket here. It just can't do what it needs to do, and so I would not expect any deal to be real, even if it's enough to sort of float the boat of stock markets in the short term. I don't think they can get a deal done that actually satisfies America.
And so, I mean, the other thing I'd say, just in terms of, most of these are themes we've spoken about, ad nauseum over the last couple of years, the last decade, about the transition that China needs to make. I guess for me, this doesn't really change the outcome of where they'll get to, but it does accelerate the process in terms of saying, if you're in this sort of long, drawn out, lost decades, then this is going to bring you down faster and get you to that sort of get them to the destination faster than they probably would have wanted to.
Yeah.
Okay. Onto this idea of the Mar-a-lago Accord and the Bessent plan. I'll give a little bit of background to this. There's two parts to this. One is Stephen Mirren, chairman of the Council of Economic Advisors to the President. So I do want to say he's sort of disclaimed. He wrote a big piece in November that I think that a lot of people sort of grabbed on as saying, okay, this is the playbook. This is what you should sort of base it on. It. Now he's already disclaimed this a lot himself, saying no, you're reading far too much into it. And it was a piece I wrote when I was a strategist of a company and as a as an investor more than others. But so with that sort of disclaimed away, basically this does fit quite well with what he's talking about. So what he's saying is something we've mirrored ourselves, is saying that, look, having large deficits is not typically the problem of, is not typically the fault of the country that has it. If you've got an open economy, then what happens is, like the US, is that you get countries that want to keep their currency low. For example, say China, they sell you $100 worth of goods, and rather than ideally then that $100 then goes back into China, they have to sell US dollars and buy Chinese yuan, and by doing so, they bring their own currency up and push your currency down, and then eventually that keeps happening, and the price of production in China goes up. So now Chinese consumers can now start affording American things, and because the Chinese yuan is rising now, Chinese goods get more expensive in America, and you sort of balance the whole thing out. But because countries don't actually play by that, and they do just keep accumulating and buying they basically leave the money in the US and just buy US treasuries with it. That leads to currencies that stay too low for too long, and you get the US dollar being too high, and that's what creates the trade deficits. And so and this is quite a long piece, so I'm paraphrasing a lot of stuff he's talking about. So his steps to fix was really, well, you got to create some leverage, and to do that, you get tariffs and you get security zone withdrawal threats, and we've seen exactly that. So here's the tariffs that are coming on, and you then try and shake up the security world in terms of saying, we're not going to defend this, we're not going to defend that, and you guys need to put more money in, and you withdraw from NATO or whatever the different things are that are going on. And then once you've done that, then you exploit the leverage by doing a deal country by country to increase for each country then to increase their currency and lower the US dollar in return for lower tariffs or security guarantees. So, for example, to Europe, you've thrown on this 20% tariff tax on Europe and withdrawn a lot of, withdraw yourself from NATO and all these types of things that's going on there. And then you turn around and say, well, if you let the euro rise by 10%, we'll bring the tariffs back to 10% and we'll give you some more security guarantees as your example. And then, similar to China. So that's sort of his rough outline for how to solve it. Now, whether it works or not or whatever, it does sort of fit with certainly what Trump's doing, sort of fits within that plan to date. Your second one then is Scott Bessent's. He's sort of got these two sort of plans, but one of them is bringing the government deficit under control with 3% GDP growth, 3% bond rates, and a 3% government deficit to sort of stabilize your US debt. And a part of that is reducing the public sector and releasing the private sector. So from sort of both these plans, what you end up with is this sort of Reagan-Thatcher style economic boom where you're basically saying government's been preventing companies from doing things. There's too much government involvement in the economy. I get the government out of the way, and then all of a sudden we get this massive economic boom, and that sort of carries us through, and that creates jobs, and all these things, all come together. And so whether you're talking about an economic boom in the US because all the manufacturing ends up in the US and much more employment and things like that, then you end up that's sort of your positive outcome. The flip side is, though, you actually end up in stagflation if it doesn't work. Either it doesn't work because there's some flaws theoretically, or as David said, it's execution risk. Is that it just gets stuffed up in the whole messaging, and the companies don't go and build stuff because they still don't really understand what's going on, and they get and in the absence of certainty, they just don't do anything. And so, and if that's the case, then you end up with stagflation. You end up with poor growth because you've got this, because of poor economic outcome, and you end up with higher inflation because a lot of the things you've done are inflationary in order to get there. So I think that's really, for me, that's what markets are grappling between. They're trying to look at those two outcomes and saying, okay, is it this? Are we being led to the promised land and this great economic boom? And we just have to go through this, we're going through a J curve. We just have to go through this little bit of problems. And then once we go through a little bit of problems, everything will be great. Or are we headed for this stagflation? And overlying the top of that is Trump is not well known for being a particularly patient person. If he sees 6 months of, if the idea was that, that your J curve means your economic growth goes down for 6 months and then starts rising from there, does he last? Can he handle 6 months worth of poor economic growth, or does he end up just firing Bessent and Merrin and getting other economic advisors whose plan is to flood the economy with stimulus and get everything booming? So Dave, your thoughts on the two outcomes? And I think, I do want to say as well, this has obviously been a big blow for the people who have got the idea of, hey, it's a Reagan-Thatcher style economic boom coming, and there's just be a few tweaks. It's now obviously a much deeper J before you get back to the growth, and which is what markets are pricing in.
Starting to, but they haven't priced what needs to be priced.
No,
I don't think. I mean, like 3% on the 10-year. We're at 4.1 at the moment, 4.06. I mean, it'll take a virtual recession to get it to 3%. which kind of becomes self-defeating because you'll have all these automatic stabilizers kick in that are quite negative for fiscal spending or positive. I mean, they'll drive fiscal spending. Tax revenue starts to go down, and so that's not necessarily going to do it for you anyway. If you didn't have the tariffs, potentially the Bessent plan. Well, I do think the Bessent plan makes a reasonable amount of sense because, like Australia, US growth, nominal growth in particular, has been driven by huge fiscal deficits since COVID, and even before that through the Trump tax cuts. So, like reining that in and giving the private sector a go is no bad thing, but when you've got the tariffs coming in as well, then you've got a potential sort of pause in the private sector, just as you're gutting fiscal, and so you end up with quite a serious growth scare, if not a recession. Then that has sort of internal dynamics that can overshoot basically to the downside. So that probably takes us to economies and markets here, which was our last section. I do think that Doge or fiscal austerity and tariffs combined.
Actually, sorry, Dave, I should actually jump in just before we get to this, do a quick sales message.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right. Yes. Economies and markets, and then we'll. There's a bunch of questions today, so I will. And just noting, anyone who else who has a question and wants something answered, drop it into the chat, and we'll have a go at those. So yes, economies and markets.
So I do think the US is headed for quite a growth scare here as fiscal austerity and tariffs collide. I don't think stocks have priced it. In fact, to get to the sort of bond yield Scott Bessent's talking about, I think you need an accident in credit spreads, that is, in corporate debt. And so I'm looking at junk bonds and, high yield credit as a pretty key indicator here on when or where there is some kind of Bessent put or Trump put. Like we need to see a bit of an accident in corporate credit, I think, before I'd be satisfied that they want to pivot back towards growth. Take their foot off fiscal a bit, and I don't know, maybe negotiate the tariff outcomes a bit faster. So like that throws up, what we've already discussed. If you put a global growth scare on top of China being the focus of tariffs and falling commodity prices, Australian inflation crumbles. Of course, with a flood of cheap goods, so that recommends local bonds, and it means the RBA is cutting faster and deeper than anyone expected, except us, of course. And so that kind of raises the prospect of buying houses, which are the most interest rate sensitive asset in the country.
Particularly so if we end up with a Liberal government who's going to give everyone $50,000 from their super to help. The
Australian dollar is a really interesting one at this point. It's fallen a long way. The market's very short and has really struggled to go lower because it's so short. And I do still think it goes lower eventually, but it's and if we do really get stocks getting hit and this global growth accident coming, then I think it would still fall, a fair way at a couple of cents. But it has been struggling to go lower, and it really hasn't fallen out of bed today, despite these new headwinds. So I think there's a bit of a question mark over it as well. But and then of course if this whole thing becomes part of some kind of Mar-a-Lago style plan, then that's designed for the US dollar to fall, then that obviously makes it more difficult for the Aussie. So the jury's out a bit on the Aussie at the moment, and I think the other implication is Australia's got this really dumb growth model at the moment that effectively delivers falling living standards to everyone, no productivity and weak wages, etc. All via mass immigration, and the end of industry here that this augurs, because we're just not going to be able to compete on anything. Means this mass immigration model is going to embed. I think there's no thought of anything else, and the alternative of trying to grow your external sector or to pivot towards productivity enhancing policies and reform just aren't on the table at all. And so unless we were to see a radical change in Canberra in either of those two directions, then they have to fill the hole of falling commodity prices, and they'll do that with more immigration, which
and
brings
coming
property again.
Yeah, and coming back to that productivity gain, creating things, it's effectively what the US is saying. We want more of this. We want more of the global share of these manufacturing things where we think we can get the productivity gains. And China's obviously in that same space, and Europe and Japan and Australia is effectively, by not having a policy, is the same as saying we actually want less of it.
Could you just hang on 1 second?
Yeah, let's go to a quick sales message.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right, so a couple of questions we've got. There's two different Scots asking questions. I must admit, I don't completely understand the first one. Amy Oster reckons investment markets are very strong, but if the US starts ramping up tariffs and global markets get a bit wobbly, do you think we'll stay competitive, or do we see capital shifting elsewhere? I think we've probably answered that. We're in that case, we're seeing capital shift out of stocks and into bonds. Second one, a different Scott Williams. Do you think the US industry will be wise enough to rebuild their manufacturing using next generation tools with greater automation? Dave?
Absolutely.
Yes.
They won't have any choice.
Yeah.
If you're going to repatriate your supply chain, you need to be profitable. So yes, 100%.
Yeah, and we've got a lot of stocks in our portfolio. Or if you're looking for a direct index tilt, you can get a direct index tilt into that robotics and automation sectors that we're certainly very we're invested in, and there's a direct index way. If you're investing in any of our products, you can just take extra of those companies that will benefit from that if you like. Then a question from. I won't even pretend to pronounce it. Trump throwing these new tariffs. How much of a curveball do you think this is going to be for global markets? We're looking at a short-term wobble, or is this properly going to shake up investment strategies?
I think we're in a bear market basically. I think we got And that's why I've included these couple of charts at the bottom on this last slide, which shows two things. The leaders of the previous cycle, the Magnificent Seven, etc., have the largest, exposure to global profits of any sector in the US. And so that makes them vulnerable. And secondly, just if you look at EPS consensus, like at the moment we're miles above anything that could be considered recessionary, and that's a long way down from here if we get close to or have a US recession.
Yeah.
And I'm not saying we're definitely having one. I just think we're going to have a major growth scare. And given these tariffs are bigger and they're more chaotic than expected, I was initially expecting this thing to probably bottom out at down 15%. Now it's more like 20. Could even be 25. It's just definitely sort of a bear market setup, I would say. And if you get into the worst case scenarios of retaliatory tariffs, then all bets are off.
Yeah, I think the only on the big tech one. So I'm going to exclude Tesla from this because I think Tesla doesn't really fit with the others. It's not like the others in terms of where it sits, and it's got all its own issues. But that's the interesting one for me in terms of if they're not facing major costs increases themselves because the chips are excluded from the tariffs. So you're seeing on that. There's an argument they've been making is that they're being unfairly targeted by the EU and all these other ones, and that actually this is some of the trade barriers that are up is for example Australia saying no, you got to buy local media content to Google and Facebook and those ones, and that's being included in this. And so does that type of stuff come up as part of the negotiating process? Is that no, you can't actually throw, you can't force our US companies to buy local stuff if we don't want them to or whatever. And so it's a little bit two-edged on that one. And the other part for that for me is of all the areas of spending that I'm seeing in terms of CapEx, that one seems to have the least amount of risk to it in terms of saying, okay, I'm building a new car factory. I just don't know where I'm going to put it anymore. I don't know if I want to put it in US. I don't know if I want to put it in Mexico. I definitely don't want to put it in China. I'll just wait and see where these tariff escalation gets to and de-escalation gets to, and then I'll decide. Whereas I think on the that front, on the spending front on terms of AI, there's still quite a big push from companies to be spending money. Because they don't want to fall behind, and definitely a huge push from militaries to and governments to keep spending money on that whole processing. It's clearly an area that can be cut. That if you when you start getting worried about stuff, do I start firing people, or do I fall back, lay back on some of these programs? But it's also one of those areas where I think if companies think we are genuinely at a turning point, which we may or may not be, close to this, real breakthroughs in whatever industry they happen to be in, then they don't really want to be the person who decides, we're going to stop spending on AI and our competitors are, and next thing their competitors are producing at half the cost of us or something like that. And so, I've sort of still got, I'm certainly bearish on a whole bunch of CapEx. I'm not necessarily convinced yet on the AI front that that's where the negative is going to emerge. Right. Any more thoughts, Dave, before we finish up?
No, that pretty much covers it, I think.
Excellent. Thanks everyone for listening in. Just a reminder, you can grab all our stuff on a whole bunch of different podcast platforms. You can most of the time we're on every Thursday at 12:30. And if you've got any questions, you can jump onto YouTube and pop them in. it also does come out as a podcast on a whole bunch of different podcast platforms. So jump in and do that. If you want to register at nucleuswealth.com/content, you can get all this, all our podcasts and writings mailed to you every week. And you can also follow us on a whole bunch of social media. Hopefully you enjoyed this. Hit the like button, and we'd love to if you would subscribe as well. Thanks, everyone, and we'll see you next week.